Having said that, there is real estate which is on the back foot, FMCG is not doing as much, even media is on the back foot, but it's IT which is doing quite well. And from the broader markets, NBCC is reacting to the news flow of that potential bonus issue. GMM Pfaudler saw that large deal happening, so that stock is in focus. Engineers India, IEX, Coforge, these are some of the names. And of course Trent, I mean, there is no question of valuations on that stock because it's, I think, over 110 times right now, but it just keeps on moving higher. 7,100 on Trent right now. And even for the markets, we're just heading higher. So let's welcome on board Nilesh Shah, who's joining us from Kotak, and we'll be shortly joined by Mihir Vora as well from the Trust Mutual Fund. Hi gentlemen, good to be speaking with you. Hi Nilesh, it seems like the market needs, market is just overlooking any bad news, if at all it's coming our way, and look at the mid cap and small cap. I mean, we have been worried about the froth and the valuations, but the liquidity is something which is something that one should not try and fight.
While liquidity is something which one should not fight because markets can remain irrational more than you can remain solvent. But at the same time, one always has to be careful, especially when liquidity-driven rally is there. No one knows where the top of the liquidity-driven rallies will be. But at the same time, focus on valuation. Price is what you pay and value is what you get. And fortunately, in today's market, while there is momentum in many stocks, there is also comfort of valuation in many stocks.
All right, there is some comfort on the valuations on some of the stocks. That's the take. But Nilesh, we are seeing that the whole sector churning is at play, and the sector churning has been quite sharp. So, given the kind of rally and momentum that we are seeing, where do you still see some opportunities or some headroom where the valuation comfort still persists?
So, one, by quality over momentum, by high floating stock counters over low floating stock counters, by diversified ownership shares rather than concentrated ownership shares, and most importantly, look at reasonable valuations over expensive valuations. Where valuations are reasonable, first was IT. In those valuations were either below or around their historical averages, and especially those IT companies in mid-cap space which are leveraging AI to deliver cheaper, better, faster solution to their customers. There is also some comfort on the FMCG. Election, monsoon and budget is putting money in the pockets of consumers, and there is opportunity today on the consumer side. Two sectors to watch out for: one, private sector banks, and second, chemical. Valuations are comfortable, but they still have to overcome the walls. One, for liquidity coverage ratio guidelines impact on profitability, and second, the dumping by China. So IT and FMCG, one can get valuation comfort now. Private banks and chemical, wait for events to play out. You will get opportunity there.
Okay, you will get opportunity in private sector banks and chemicals once those challenges are met with, but there are definite tailwinds in FMCG and IT. Rohit, I'll come to you in a minute, but just let me wrap up the conversation with Nilesh as well. I understand, Nilesh, you're talking about the fact that there are certain pockets in the market which have the comfort of reasonable valuations, but what do you make of the froth in the markets at the lower end? And I'm talking about small cap and SMEs, and we have seen the kind of IPO rush which has been there in the market and the kind of subscription it's got. What would be the word of caution coming in for at least those segments of the markets?
Always remember, price is what you pay and value is what you get. When I started my career in the early 90s, there was a small cap exchange called Over-the-Counter Exchange of India, OTCEI. Most of the companies listed on OTCEI today don't exist. Most of the investors who invested in shares listed on OTCEI today have lost their entire capital and investments. So please be aware that price is what you are paying and value is what you are going to get. If you are paying 50 times forward earning, that means you are investing keeping in mind 2074. If you are paying 100 times PE, you are looking at 2124. Obviously, earnings growth can shorten that horizon, but be very, very clear what you are buying into. Don't buy momentum, buy quality.
All right, don't buy momentum, buy quality. That's the advice coming in from Nilesh. But with this, thank you so much, Nilesh, for taking the time out and joining with us on this day where we are seeing great moves on the benchmark indices. Indeed, always a pleasure having you. But with this, let's also welcome on board Mihir Vora, who is the CIO of Trust Mutual Fund. Mihir, I'll come to you in a bit, but we also have Rohit Srivastava with us. And hi, Rohit, very good afternoon. Great moves on the benchmark indices, and in this particular month itself is the second time that we are seeing Nifty 50 touching an all-time high levels. I'm sure it's one more to many more to come for the record high levels. But from here, where do you see Nifty 50 headed, as well as any take on Bank Nifty as well, Rohit?
Yeah, thank you for having me on. And we have been waiting for this all-time high level to be hit. Now that we are here, the next set of levels that we should keep in mind, at least in the near term, should be around 25,550 and up to around 20,700. So those are going to be the two new goalposts that we'll be watching for. What I'm slightly surprised by, though, is that this move is still not attracting attention on the banking side. Though I do see a lot of momentum in financial stocks. So possibly if you only end up looking at Bank Nifty, it may not give us the complete picture. For example, even yesterday, you had the CNX Finance or Financial Services Index actually doing much better. So I am seeing strength in individual names, especially NBFCs and all. So I do think financial stocks have a long way to catch up. Bank Nifty, in fact, should be testing 51,940 in the days ahead. That's around just a 60% retracement of the previous fall. So that's how far behind the Bank Nifty is compared to Nifty, which is already at an all-time high. So it's got a lot of catch up to do. And as it does that, it will again add further momentum to the Nifty itself, as banking is a significant weight there. So that is why I think the rotation is essentially keeping the momentum in the Nifty going. And we will continue to see new highs at least for the next 2 to 3 weeks.
25,500 to watch out for, and of course banking index when it participates, that's the big question. Let me toss that question to Mihir Vora then. Mihir, when do we expect the financials to finally fire up, and what exactly is making markets go to fresh highs? Because to my mind, earnings season was fairly mixed. It wasn't a clear-cut case of upgrades this time around. Yes, the rate cycle seems to have turned, but what else do you think is driving the market apart from liquidity?
Hi. I think, first of all, congratulations to all of us. I don't think anybody's complaining when the market is reaching new highs. So enjoy it while it's there. And you rightly mentioned that at the aggregate level, earnings have not been as great, both for the Nifty 50 as well as for the broader markets of 500 stocks or so. So obviously, on one side, you have earnings which are kind of decelerating, I would say, not going down, but the momentum is not as great as it was last couple of quarters. And that's primarily because the margin tailwind that we had for the last 2-3 quarters is no longer there. So I think it's back to normal margins and normalized commodity prices, and that's what we are seeing. But having said that, as you rightly mentioned, some of the pockets like financial services, especially within financial services, the banks and the NBFCs, they have underperformed, and rightly so, because we did see some margin pressure emerging. Credit growth has not been great, and RBI has been clamping down on the faster growing segments, which also happen to be the more lucrative segments in terms of margins, which is the unsecured loans, etc. So you had 2 or 3 kind of minor or mild headwinds, I would say. On the positive side, of course, the sector is as healthy as it has ever been in terms of NPAs, balance sheet cleanup, availability of capital. So I think all that is setting the base for a nice pickup as and when we see the financial conditions easing. And given the global situation where we do expect the Fed to start cutting rates as early as next month, I think the worst of the tightening is over. And in the next couple of quarters, we should see the financials with the lenders basically doing well. And as I think Rohit just mentioned a little while ago, within the financials, the other part has been doing well actually. The capital markets link, the wealth managers, the brokers, the exchanges, etc. That part has been doing well, So I think the market is still discerning. It is identifying pockets of growth and rewarding that and punishing the pockets where growth is slowing down. So I think they're still not in bubble territory, not in complete frenzy. But of course, it's always wise to be choosy and not go down the quality curve.
All right. Hi, very good afternoon, Mihir, and indeed great moves on the indices. But you just shared your take on the financials, but there's a lot of sector churning that is happening, and even Rohit was mentioning that it's the rotation that is keeping the indices in momentum. But for today, it's the IT and the pharma space that has hit its all-time high levels. But going ahead, which sector could be on the front lead, Mihir? Any take on that? Where do you still find opportunities?
So I think what we have tweaked in terms of our approach, I would say, is that it's trying to be more stock specific than take a top-down sector call. 6 months ago, 3 months ago, or even 1 year ago, it was easy to take a top-down call on some of the sectors like, say, defense and railways and the renewable space because they were relatively still under-owned. And understood, so to say. But now I think they are pretty much mainstream, widely owned, and a lot of volumes happening. So obviously, even the retail investors are in the game for those segments. So they are no longer relatively undiscovered segments. So I think while we continue to like these segments like these, we are more choosy and not taking a big sector allocation call on this. We are going more bottom up now. I would say the pockets where I can see some good balance is, as we discussed, financials, especially the lenders, which have gone through a bit of a squeeze in the last few quarters, but things are looking up going forward. And typically, we have seen the market do tend to discount good news or bad news a little bit in advance.
Well, yes, that's been always the nature of the market. Thanks so much, Mihir, for joining us with that quick take. But back to you, Rohit. In terms of the segments, you talked about how financials are underperforming, but talk to me about IT. That one is clearly firing in the trading session. And what else is something that looks ripe for a breakout, maybe a sectoral call or some theme that looks good?
Yeah, so I do think IT is playing a big catch-up, given that global IT stocks have already done well. The Indian IT stocks were lagging behind for a long time. So that is getting priced in. If I simply look at the IT index, it looks like heading towards 48, 49,000 in the coming weeks. So possibly got a long way to go. Among other sectors, what should be interesting, given that we are talking of lower bond yields, what it typically does is it kickstarts the commodity cycle. And the moment we talk about the commodity cycle, we start looking at metal stocks. So the metal sector, I think, has started to gain momentum. We are seeing that across the board. The metal index itself has taken support on the 40-day average and started to move up. So I think that's one sector where you will see fresh investments come in and where the momentum will gain further traction. In fact, metal stocks actually have done better than metal prices over the last 2 to 3 quarters as well, specifically in India. Even though it may be slow, but they have done so. Now, one of the outperforming sectors, though, another one which people should take note of, which is showing up over the last couple of weeks, is consumer durables. It's moved up around 10%, I think, over the last 2 to 3 weeks. And that may continue to show momentum because even when we saw a correction in the most recent period because of the Hindenburg report and the yen carry trade issues, we actually saw relative outperformance of the Nifty consumer durable index. So that's one sector which is clearly showing outperformance and should be focused upon.
All right, Rohit, with this we let you go, and thank you so much for taking the time out and talking to us on a day where we are seeing great moves, as well as right now where should traders and investors can have their eyes on. Thank you so much for helping us with that take. But with this, viewers, let's move on.
If you like this video, then like, share and subscribe to ET Now.